I'm only about a half an hour late. So now the final part we need to do here is to configure our exiting strategy. And what that's going to take is that we need to, of course, observe the convergence and divergence of those two strategies, which, you know what, I'm going to go over here and just copy from this strategy instead of having to set it all the way back up. Just going to copy from here. All right. And then I'm going to go to my exiting leg. I'm going to paste it here. And I'm going to set it up so that now I want the tolerance to be greater than or equal to, and again, I have not done my own analysis. I'm just going to set this to 0.21, okay? And this is calculated based on a percentage because basically these two stocks are normalized by using their percentage instead of looking at their prices. All right, and so what we want to observe here is we want to look at the bid of Home Depot because that's what we will be selling at, and we also want to look at the ask of Lowe's because that's what we will be buying to cover at. All right, and so everything else can stay the exact same way. It doesn't matter if this said sell, this would just need to be sell here. It doesn't matter because what we're saying with this setup is that we want you to emit this signal. And as long as we have this information here at the attribute matching, it doesn't matter. All right. And so we're going to cancel. We're going to close that. And before I go on to back test it, does anybody have any questions?
So are you going for any specific target, Leonard?
No. Basically what we're looking at is we're just looking at our convergence and divergence amounts as our entry and our target. So here, when I set this exiting, I was basically setting that target. This is my target right here. Because what I'm saying is if the bid of Home Depot and the ask, if the difference between the bid and the ask of these two assets are greater than this, then that is my exit. Now, of course, in a real world scenario, you would want to begin to look at not between probably, okay, as you're exiting. Because if you can imagine that in the real world, you would probably want to stop at some point because I have done some testing and I saw that Lowe's just had a blowout day, right? Lowe's had a blowout day and they never did a diverge the way that you expected it. They converged and kept going in opposite directions. That did happen, okay? And so there was obviously something that was positive for Lowe's that day and something negative for, Home Depot, because you know how the market works. If, like one asset is doing something, Lowe's had something going on and that was bad for Home Depot, so they went in the opposite direction. And so, again, this is just for testing, but the whole idea is that, and I'm going to set it back to where I had it, but the whole idea is that you're using the convergence, which could be a zero or a negative number, or maybe for some, you just want them to come close enough, okay? And then you exit using the divergence, meaning a positive number, because you're expecting that Home Depot, in this case, will outperform Lowe's. And so when they spread back out, you make your money. Is that making sense?
Yep.
Okay. All right. So, yeah, this guy is your target. And I'll explain more about the math a little later about how that works. All right. So, because basically it's just the difference in percentage. So if Home Depot was up 1.2% and Lowe's was up 1%, then this difference would be 0.01 away from closing out. Does that make sense? Or to be more exact, if Home Depot was up 1.21% and Lowe's was up 1%, then this would close out. Now I'm using the opening prices as a gauge, but that's not actually what happens, because basically once I go back in here, I plan to use the numbers as to where you actually purchase the assets and not actually where they are relative to their open. And so that's going to be a big difference. So if you can imagine, they crossed and you entered, and so then they even, went the same distance in the opposite direction. So you actually went double the distance. And so right now, the signal only is looking at how far they are from their open and close, the difference between the open and close. So I'm gonna make it more robust, but I just wanted to show you the concept today. Is that making sense?
Yep.
Okay.
Yeah.
All right. So we've set up our legs, and we're going to back test a few days, and I want to show you the behavior here. And so basically, many of you have seen the back test. There's probably a few of you on the line that actually architected the back test for me. And so we have the calendar here. We have, a starting point and our ending point, and we have, basically the speed or of the simulated quote interval, which determines the accuracy of the back test. I have it set at 15 seconds, and I am actually running on the development box right now, and so it may seem a little slow, whereas most of you have i7s and all this other stuff that can zip right through these things. And so we're just going to run it, and then we're going to look at a few results to see what happens. But the main thing is that we now have a tool that many people tend to trade with options in this manner. So, like for instance, you may be looking at a scenario where like you may have an option that is acting like your insurance, okay, for your trade. It's acting like your insurance by, say, you may place a put. You may place a put, and then you might go long on a trade, and that put is acting as if it was the insurance for that trade. Well, let's see what's going on here. I'm not sure if I got this thing set up properly, but this doesn't appear to be behaving right. Let's go look and see. Let's go look at some trades. I did stop it, right? Let's go look and see what's going on. We shouldn't have that many trades.
Check your dates, Leonard. You went back over a year.
Yeah.
Yeah, that is not what is causing this ridiculous behavior right here. I mean, that wouldn't happen. There's something not set up right in the order. Let me go and check something. And go look at these numbers. All right. Here's our Converge and Diverge. Less than. Okay, let me set this guy to 1 minute. I did make sure I set that to short. Yeah. Sell short. Looks fine. Check this. Order adjustment. No, we don't need to order. I'm sorry. Here's what's wrong. Okay, this is our stop loss. So yeah, right here, we should have set an order command to close out all positions. Okay. This is a new feature too. Basically, what we're saying is close out all positions, and we're expecting a minimum orders to exist of 2. Okay. Because we just don't want this thing to just look at one order and say, oh, well, I'm going to go close that order. We're basically telling it that there's 2 orders out there that you can't execute unless you see both of these orders. And so this stays false until that is true. All right, let's see. Sell, positive. Okay. Now, let's go see what is going on here. Yeah, we shouldn't have had that many orders. That was a lot of orders. So it's essentially looking for those convergence and divergence behaviors in that particular day. I find this pretty interesting. I've been, knowing a lot of you for years, and I really appreciate you supporting me. Even some of you that have left, you still left behind something that has made this software better. And I just can't thank all of you enough. And I'm going to be relentless on this stuff while we're all looking for a great solution. I'm just going to stop right here instead of having us kind of sit through this, because I definitely want to get to the open discussion as soon as possible. And let's go look at and see, and so you can kind of get an idea of the behavior of the trades. All right. So, okay. So now, please excuse me while, again, this was just built on Friday, and so we don't have true I guess I should say multiple type order chart support to display, how this happened. Okay. So, but basically you can see it may be a little hard. I'm gonna have a line here to show you how this is thinking. Okay. So right in here, Home Depot and Lowe's, they converged. All right. Make sure I'm clicking on the same day. They converged. And what happened over here is that it bought, and then it bought and sold short, and then it sold and covered. Okay? If you notice the times, well, that's a little awkward, and we need to do something about that, because those times should have been a little bit closer than that. But the idea is that we open two orders that will be working together for us, and then we're closing two orders that hopefully have made profit. And I'm not sure if let me see if I can calculate this. So we sold short, we are lower, we bought, but we're lower, okay? And so, so we're lower there, and we're lower here. Now, again, remember how I was telling you earlier that when I do my final implementation of this, the calculation of the divergence will be based on where you bought the order, or I should say where you entered both of the stocks. Okay, or assets, ETFs, whatever. Okay, and so in this case, when it diverged, we can see Home Depot went down a little bit, but Lowe's went down a little bit more. Okay, it's pretty hard to see on this chart, but it happened. And so again, right in here, they converged, and you can see where Home Depot went down a little bit, but Lowe's went down a lot, and well, I won't say a lot, but it went down. It went down enough for us to make a profit in the difference of the convergence and divergence. All right. And so over here, we probably just had some that didn't close out for an entire day. And so that's what, yeah. And so this is something that, like once we start to get into the details of like how you truly would manage this. So like, for instance, remember how I was showing you over there in the order about how you would maybe, look at the closing side using two parts. I'm better at showing this than I am saying it. Okay, so this is our exiting leg. And so this is our exiting leg. And so we would possibly have this set up where it would be not between, okay? And so this would be our upper side, meaning like, if we got into big trouble, like say if we got into big trouble like a 0.6 thing over here, all right, and then our profit taking would be maybe 0.25 something. And so if it ever got outside of this range or outside of that range, we would exit the trade. So this is more of a take a loss, take a win type scenario. All right, but I just did this demo with just one side, okay? Now, again, this is just just a scenario where we found some convergence, and then the back test just closed at the end of the day, and it was for a loss. Whereas some of you might go to the next day and it be a blowout win. I think I had that. I think I have this setting checked. Yes, to where we're closing out the end of the day. Where is that at? Yeah, right here. Sell at the end of the day. If we leave open until sold, we might get a totally different behavior there. And so these other 3 days, again, here's another same scenario. It found a convergence, and then it found a divergence, and it never found any more convergences to enter into the trade. But I think everyone kind of gets the concept of, we have a stock that we believe is always going to outperform. Now, of course, there are so many strategies that we can put at the head of our order, or like to basically check. So, like if I was running robots, I would have something that says, okay, if the Nasdaq at any point of the day was greater than a certain amount than the S&P, then I would definitely want to put on the S&P and Nasdaq pair. If they're trading in a very close term for proximity for the most of the day, I probably wouldn't trade them. But as most of us know, because we watch the market, the Nasdaq has been outperforming the S&P for I don't know how long. So that's a safe convergence. And from my own personal observation, I've rarely seen the Nasdaq be a very high percentage above the S&P and then trend below it percentage-wise. So normally when it's above, it stays above. All right. Let's see. So, okay, so we had 3 losing days, and we had our good trade day. It basically put on, even though it was 8 trades, it was actually 2. Because you divide it by 4, because you're 2 in and you're 2 out. And I think I've more than covered what this thing is, and I know it's fairly complex, but these are the type of things I've always told everyone to draw it out. And once you draw it out, because there's no way that I could have explained it to you about which, how to select which price to observe when you're thinking about, okay, I need to buy $100,000 in market value of this particular asset. Well, you need to think about, well, I'm entering a long, so therefore I'm going to be observing the asking price, or I'm going to be observing the bidding price if I'm shorting. So therefore, when I enter both of these guys, I want this guy to be 100K at that price, and I know that that's being very, specific and accurate and all that stuff, because normally the threshold between these guys are 3 pennies, but we still want to make sure that we observe that, because the entire idea is that we want that convergence or more than that convergence, and we want our assets at that point in time to be priced properly, so that when we exit, we're exiting properly, and so that we get our price differences and make a profit. So I'm going to, I guess, stop there, and I definitely want to hear from all my good friends and talk a little bit about what this means, how what are some good ideas and some other things about it. So the floor is open for the next 15 minutes, and so anybody want to step up and talk or ask a question or whatever.
Leonard, this is Dave. On the stop loss, so then by switching it over to the in-between would provide you with a stopgap measure in case the divergences went against you on both ways, correct?
Exactly. Exactly. That's what I was attempting to show here. And so, and again, you got to understand, I just built this, so I don't even know all of the different ways I can use it yet. But when I did think about, I thought about, okay, well, what would be my get in trouble price, and what would be my, the way that I would actually handle this. And so the way I would handle it, again, we would use a negative number as our exiting, because when they converge, the number turns negative. Okay. I'm sorry, 0 to negative. All right. Mm-hmm. And then on my profit side, I would just say, okay, 0.2 here or 0.25. Okay. And so, again, that This value is the difference in percentage points. So that's what we're looking at. And so what, again, I haven't sat down and looked at it, but I really do want to observe is when you enter the order, looking at the two prices from a percentage standpoint, and then calculating from where you bought them to calculate the convergence and divergence. Because the way that I'm doing it right now in this sample is nothing like probably what you really want it to be in the real world. So in the real world, I'm going to open up my chart that we've been drawing on. In the real world, if these guys crossed, say like if you got them and they were extremely crossed, okay, and by the time they come back together and pass each other again, this may be far more than calculating it just by the comparison of when they opened. Because on this chart, we're looking at, the divergences based on the open, not based on when I actually bought it, which is a totally different calculation. And I think it's going to yield a more, robust profit, if you ask me. But I haven't sat down to do it, but I'm definitely going to add that in here, and it'll probably just be some setting here that will afford you to say, okay, observe, where I actually entered the order at, versus the open of those two assets. And I know that this is extremely complex, depending on who you are and and the way you look at the market, but it's needed. And I've tried to keep it as simple as possible. Just but you really need to understand like the three prices, bid, ask, last. Understand how they come into play when you're trading. But the entire idea is that you're using the bid and ask because those are your soldiers that we're observing to determine if that convergence or divergence actually happened. Because if we looked at the last, you would just totally be losing money. Let's see. Somebody's asking a question. Let me see. I think that's Wes. Hold on one second. Let me close this. All right. Also proud to announce that we just added a new broker. Wes, for some reason, I just lost your chat. Okay, Leonard. Does it matter if you have low as an asset and HD as 2? Yes, it does. It definitely matters because, well, let me explain it like this. Let me open up that particular part of the strategy. Okay. Now, if this was Home Depot here and this was Lowe's here, what you would need to do is to understand how this is going to be calculated. That's why I added this asset 1 minus asset 2. Okay. And so what this is saying is that I'm going to subtract the percentage of gain on the open, okay, and subtract asset 2's percentage change in comparison to asset 1, okay? And so if you flip them upside down and you don't flip this information or this setting, then you're going to get a crazy calculation. That's why most of the time when we're setting up, a new signal, is unless you truly can grasp what is going on, we've set it up in a way that you can just kind of go in there and start using it, okay? This might be in some other extreme scenario where you want to invert it and you understand something else. But basically, the way we want you to think about it is that asset 1 is your long, and then asset 2 would be your short. Now, if you understand exactly what you're doing, you can flip them upside down and flip the price types upside down and calculate it differently, and it'll give you the same result. But the whole idea is that we want to look at two different assets that like for instance, I think I gave someone an example the other day, like a McDonald's and a Hardee's. Now I'm just bringing up those two because just right off the rip, most people know McDonald's. Some of you probably don't even know what Hardee's is. But if Hardee's did trade publicly, it would probably underperform McDonald's, probably. And so we want to observe those two because we can beat up on Hardee's and hope that McDonald's always outperforms it. And if that's the case, then you're going to get a nice pairs trade. It may be times where, where there's no divergence. I haven't observed that, but just like when you're looking at this chart, there are plenty of opportunities to enter into this trade, and then there are plenty of opportunities to exit. Because again, we don't care about if they both go up or they both go down. We just care that they eventually spread back out. That's all we care about. Because when they do, it's going to be money on the table. And especially once I put in, the more I think about it, once I put in the comparison based on where the order was purchased, that back test is going to blow out the water. Right now it's strictly just based on the close of those two assets, and that's not particularly accurate. Okay. Now, let's see. Why did you select HD as asset one instead of low? Is it because HD normally outperforms lows? The answer to that, Wes, is correct. Yes. In this scenario, you would definitely need to understand the dynamic between the two assets that you're selecting, hoping that that you would always select a long asset that, historically outperforms the other. Like, for instance, another example might be Facebook and Twitter. All of us know without looking, once they both settled down, we know that Twitter got extremely volatile after Facebook was, after Twitter became an IPO, it became volatile. It went up very strong. Everybody's like, okay, it was trading right behind Facebook. Then eventually it just lost its luster. It's the number two guy, even though they're in two slithers of the social media market. It just doesn't perform as well as Facebook. Now, Facebook's been waffling, but as of I guess last week, Facebook began to break back out again, and so that would be another possible pair. I'm not here to, I guess, help you select a pair. You just need to understand the dynamic and why this type of trade works. Because if you choose, an Apple over a Micron, you may. I'm sorry. If you expect Apple to underperform something like an AT&T or whatever other pair, it's probably not going to happen. You're probably going to end up upside down unless you just catch a day where Apple goes down and the other one goes up. So you want to think, logically about, and not to make light, but basically if you overlay the two charts and you see that there's because first of all, there has to be a correlation. If there's not a correlation, you may be dealing with the wrong two pairs anyway. You need a correlation so that you know that the behavior is going to be within your risk tolerance, because you don't want something that's extremely volatile going all over the place and the other stock is not trading with it. Because if it doesn't trade with it, then you're going to be hitting your stops every single time. Wes asked said another question. Great, thank you. Similar to MasterCard and Visa. I'm not sure who's the outperformer in there, but if you see a correlation, but you see an underperformance or outperformance between the two, then that may be a good pair. All right. Anybody else? Anybody? All right. So I guess that we are about 8 minutes away from conclusion, and I really hope that that some of you got some value out of this. Even if you're not with ionDESK, the whole thing was to kind of bring us together and talk about this and bring up any issues that you might see or things that, again, this thing was basically built off of most of you giving me ideas, and so this is a good platform for it, and I think that it turned out pretty well. And so I'll be looking to, I guess, speak to you individually or as teams as some of us have done before, and I hope that you got some value out of this. And without further ado, I guess that I will close. And as I say in all of my emails, I would like to bid you adieu. So I guess that is it. Still got some people hanging around. Anyone else want to chat about anything? Or all right, everybody's closing out. Yes, Wes, you still there? You're welcome to unmute. There's nobody else there, I don't think. Hello. Hello. Yes. Yes, Wes, do you want to unmute? Oh, okay. You're in a busy place. Okay. Go ahead and ask your question. Okay, Wes, go ahead and ask. Hello. Is the contingent strategy you used today now the finished version of the pairs trading you were talking about last week? Almost. It is a almost finished working on the help, and we're definitely going to be testing it. And as I was speaking about the math involved with it, I definitely want to revisit the calculation and base the calculation on the order and not the close of the orders, because I think that will yield a much better result than what we've seen in the back test today. Far better, because as soon as they converge and diverge, you should get a very high ratio, in my opinion, of profitability. Make sense? Anything else, Wes? Okay. Well, here's Wes has asked, can you elaborate a little bit more? So, like, for instance, when we're calculating as of Friday, this Friday, when we're calculating the divergence, it is based on the difference of when it opened. So if you look at Lowe's right here, there's Lowe's and there is Home Depot, right? Now, there is divergence here, okay, and that's fine. But what if we had an extreme convergence that was crossed right here? Like, instead of it being just a little bit, we had an extreme cross to where we could actually enter our short up here and enter our long here. So when we got this opening back up, and it's calculated based on when we bought this order, we would get a far higher profitability than just calculating it based on the open and close divergence, which, in other words, this right here may yield the threshold that you're looking for a lot faster than this area right here. Okay? The difference in percentages. And so once we get it based on the order, where you actually bought and shorted those orders at, you will get a very strong profitability in my opinion. So we just need to change that, upgrade that calculation. Now, of course, when you're entering, you don't have an order yet, so it will be solely based on the percentages of the two assets compared to their opening price. But when we're exiting, we definitely want to look at, well, where did we actually get them? It may the percentage change. It may be far greater than, once they diverge, it may be far greater than our current calculation. Does that make sense? Okay. Well, Wes, I really appreciate you staying on and watching the video. And, of course, this was partly inspired by your questions a few, maybe a month ago. So I really appreciate it, and we think this is going to be a great add-in. And I didn't get a chance to tell the others, but we do plan on this being a very expensive signal, but for our current customers, we're going to let you have it for free. So that is my gift back to everyone that has been with us up to this time. So I hope that everybody can get a good use of that. So at this time, I'm going to exit at 8 o'clock, and we're right on time. And I look forward to speaking to you again. Thank you.